SPACs just won't die. We lived through the boom of 2021 when the blank check mergers accounted for 61% of all U.S. public listings in that year. Also the subsequent bust, with at least a dozen going bankrupt since then and more than 100 now running low on cash. But even though most of us stopped paying attention, SPACs continue to live on. Now, 2 years later, there are signs of a resurgence and some investors are even seeing new opportunities. This week on Tech Check, zombie SPACs back from the dead. Now, two of the highest profile SPACs, Open Door and Virgin Galactic, they reached their highs in 2021. Like many from that gilded era, they have since cratered in value. Both have fallen more than 90% from those highs, yet some of those SPACs may be getting a second life from investors who see opportunity in the wreckage.
Every company that went public through the SPAC now, treated as a quote-unquote bad company. But, I don't believe that all 300 companies are bad companies.
Imran Khan was involved in two of the largest tech IPOs ever, Alibaba and Snap, and he was also Snap's chief strategy officer. He says that because of the boom and bust, all SPACs have gotten a bad rep. But that within that mix, there are good companies, ones with strong financials and paths to profitability, and massively undervalued. That is an opening for what he calls valuation arbitrage. It might be easier to explain using an example. Dave is a banking app with millions of users that gives you a checking account without any fees, also advances and overdraft protection. It went public through a SPAC in January of 2022 with a market cap of about $3 billion. Today, it's worth less than $100 million. But Imran says that when he looked through the financials, he saw a company with a better profile than a Series A or an early stage startup, but way cheaper in the public markets.
The company has 2 million customers, does around $250 million revenue, and the market cap is $85 million. When I look at the private market valuation and when I look at this public market valuation, I think we're finding great value in public market.
That's his arbitrage. And he says that he's founded an Open Door and Grab, a Singapore-based super app that fell 21% the day it debuted and never reached those highs again. SPACs have been around for a long time, and although they've always had a more questionable reputation, Imran has an idea of what went wrong in the past few years. Traditional IPOs must give prospective investors its financial background, how much revenue it's made, how much it's earned or lost over the last 2 years. The company cannot talk about future financial performance. But when merging with a blank check company, businesses follow M&A rules instead. So SPACs are a little looser and they allow you to offer those financial predictions. And that is a big draw for a startup with slowing sales or no profits, especially as COVID shut down the whole economy. When pitching investors, they could instead focus on pitching a growth story, leaving it up to investors to believe it or not. Take a company like Lucid Motors, which makes electric vehicles. Pitching to retail investors before going public, it said it was on pace to deliver 20,000 vehicles in 2022. Are you on track for 20,000 vehicles in 2022?
We're very much on track for our plan. We're aiming for over 577 vehicles this year and a significant increase throughout next year as we grow the business.
Okay, but you won't repeat that 20,000 number. I'm noticing, Peter. Are there some hesitations around that? Is there any reason to think that you might not be able to hit that number that you laid out?
I'm very optimistic about our future potential for manufacturing.
Post-debut, it slashed that forecast again and again, from 14,000 to 6,000, hiking prices and burning money all along the way. It passed that last goal, producing just over 7,000 vehicles last year, but it's cut forecasts again this year. Another category of startup that hopped on the SPAC train but met a similar fate, electric scooters. Bird, for example, forecast revenue would hit over $400 million by 2022. Investors in this case didn't buy it. Its stock plunged immediately after completing the merger, and in 2022 it posted just $245 million in sales. Imran Khan says that if he were leading a SPAC, he wouldn't provide any future financials because of what happens if a company falls short.
The entire U.S. capital market is built on trust. And when you go public and provide some sort of guidance and you are significantly far off from that guidance, you ruin your trust with investors.
A lot of the broken trust fell on the SPAC sponsors, big names who use their platforms to promote the companies and talk up a future performance that would never come true. They were often making money just by taking the company public. It didn't really matter how the shares did once they were public. And it wasn't until later that many investors learned that as their own holdings crashed. The biggest promoter of them all might have been Chamath Palihapitiya, dubbed the king of SPACs. In late 2020, he had 6 in his rotation, including Virgin Galactic, Clover Health, Opendoor, and SoFi. He went on Twitter and he went on TV, hyping up the companies and the growth that they would see.
Basically, it's about capitalizing something that will put people into space, but build technology that over time will do everything from space tourism to potentially hypersonic air travel. Opendoor will be going public. This is the largest online consumer real estate business in the United States. It's doing something really incredible. Clover is already growing 2 to 3 times faster than their next 9 nearest competitors.
3 of those are down 90% or more from their highs, and SoFi is down 65%. When investors, those who believed his hype and then suffered enormous losses, tried to hold him accountable, his response went viral. "I'm in the arena trying stuff," he said. "Some will work, some won't, but always learning." He also blamed investors, asking them why didn't they sell when he did, and told them to stop being victims. By taking those companies public, Chamath has said that he has doubled his money, banking about $750 million. Despite the fallout, SPACs still aren't dead. In fact, they're making a comeback, many under similarly high-risk circumstances. Better.com is an online mortgage lender that has had a tough road going public, as rates hit their highest in 2 decades. So instead, it turned to a SPAC, which allowed it to get a capital influx more quickly than in a traditional IPO. The SoftBank-backed company first announced plans to go public in 2021 at a roughly $7.7 billion valuation. Mortgage rates plunged after COVID, and as millions of homeowners refinanced, the company posted $172 million in profit in 2020. But the boom times didn't last.
We had a period where we had grown from doing $500 million a year of originations back in 2017 to getting to $5 billion a year by 2019 to going to over $58 billion in 2021. So if you can imagine this 100x period of growth, all coming to a very, very crashing end as mortgage rates started to increase.
Rates began ticking higher and the company started hemorrhaging cash. It delayed its IPO after grabbing headlines for laying off 900 employees via Zoom, and it faced an investigation from the SEC. So instead, Better.com, it went public just last week, just as mortgage demand hit its lowest level in more than 2 decades.
Rather than raise capital privately, you decided to pursue a SPAC. At the time, it was the way that everybody was trying to raise capital. And there were real questions about this is now taking 2 years to close effectively, whether it would close, whether this was the best path, whether you should have tried to walk away from this deal.
It made some sense. The completion of the merger with the SPAC company gave Better.com a much-needed $550 million cash infusion from SoftBank.
We had a committed deal where our SPAC sponsor plus SoftBank were committing $1.25 billion of capital to the company. And ultimately, that amount of capital is not available in the private markets for mortgage companies nowadays.
But the debut was a bloodbath. Shares cratered more than 93%, finishing the session at just $1.15. And although that might seem like a sign that investors are done with SPACs, another recent debut signals the opposite. Vietnamese EV startup VinFast went public through a blank check company earlier this month, and its meteoric rise is almost unfathomable.
190 miles, $52,000 with uneasy or unsteady ride and handling, according to Car and Driver, and $191 billion valuation. What in the what is going on here, Herb?
Shares have surged almost 700% to the point that it is now the world's 3rd most valuable automaker, only behind Tesla and Toyota. $190 billion market cap, that makes it bigger than Ford, GM, Boeing, and Disney. That blowout debut, even though VinFast sold just 24,000 cars in 2022 and lost nearly $600 million in the first quarter of this year.
So at a $191 billion valuation, that comes out, to carry the 2 divide by, comes out to $3.8 million per car sold.
And it's no squeeze. Short interest has fallen to almost zero, according to S3 Partners. But that volatility likely due to its very small float. Only about 16 to 17 million shares are available for trading. The rest of the 2.3 billion shares are held by insiders, making it surge more of an arbitrary number, less indication of its worth. But here we are, a massive day one move, an EV SPAC, nosebleed valuations. You could be excused if you think it feels like 2021 all over again.